Good morning, welcome to Ainsley News. It's Wednesday, the 13th of January. Today we're talking silver, the great rotation. One of the more successful fund managers around is thumping the table about silver right now. Regular readers will know we respect the work of Crescat Capital. Why? Because they look objectively at the market and don't get caught up in the passive crowd. Their performance also speaks for itself, as you can see in this next chart we're going to show you here, with their net performance. So they have credibility, and by not following the crowd into the abyss in their GFC, the performance including the period that sees them hundreds of percentage points above the benchmarks when inception predates that period. So what are they saying now? Here are some excerpts from their latest piece. It's time to gird for full modern monetary theory. With the democratic sweep in place, we are about to experience even more of the double-barreled fiscal and monetary stimulus that we saw in 2020. Overwhelmingly today, such policies have served to incite animal spirits towards financial assets. Investors are already positioned, all in on both stocks and bonds in the US, creating a highly imbalanced market. The problem is that money printing married with fiscal spending is crashing head-on with an emerging commodity supply problem that will likely stir up rising inflation, which is bearish for both equities and fixed income. Get ready for a volatile 2021, the year of reckoning for twin asset bubbles, as the world attempts to emerge from the COVID-19 pandemic. The macro setup is in place for a self-reinforcing unwinding for stocks and rise in commodities akin to 1920 to 21, 1973 to 74, and 2000 to 2002. On the long side of this trade, there are merely two sectors in the US stock market, energy and materials, that offer substantial value and upside potential today as part of this macro reconciliation. We believe the smart money is already rotating out of historically overvalued equities and fixed income securities and into undervalued commodities. Soon it should become a stampede, a great rotation. The Fed is determined to increase the rate of inflation to ease the record debt burden, dragging down economic growth. The fiscal powers will be playing along, so inflation is indeed what we will likely get. Long-term economic history proves that the force of rising wholesale and consumer prices cannot easily be brought back under control by central banks once they get loose. But what about the output gap in recent years, the theoretical paradox holding inflation in check due to an underachieving economy? And what about the deflationary forces of technological innovation and aging demographics? At this stage of the macro cycle, in our analysis, inflation is all about the input gap, i.e. the shortage or supply shortage of primary resources. While the new economy has been enjoying the limelight in recent years, the stage for cost-push inflation has been set due to underinvestment in the old economy, now that policymakers are about to pull out their biggest bazookas yet to boost aggregate demand. Global central banks added a total of $9.1 trillion of assets to their balance sheets in 2020. To compare, this year's monetary stimulus was about 3 times their response to the global financial crisis in 2008. We also saw at least $25 trillion of newly issued debt worldwide, while the aggregate value of all negative yielding bonds reached close to $18 trillion in 2020. With this macro backdrop, it's staggering to see a monetary metal like silver still trading sub $30 an ounce. Here's the global central bank's asset chart here. USD billions, or 9.2 trillion in 2020. With gold and silver closing past year up 25% and 48% respectively, miners are in paradise. They have never reported this much positive free cash flow in a quarter. Over 60% of the newly generated capital was used to pay down debt, which was the largest quarterly amount in the history of this industry. Here's the gold and silver miners chart here showing their position. Change in short and long-term borrowing. With such a massive paydown in debt and all that free cash flow, one would likely assume they would be deploying funds to look for new deposits and improve production capacity. But quite the opposite has occurred. While we have shown in past letters that future gold supply is historically constrained due to underinvestment, the lack of investment in silver mining looks even worse. One way to see this is by looking at the capital spending cycle for miners that more prominently focus on silver production. If we look at the SIL or ETF, or SIL ETF members as a proxy, their aggregate capex just reached a decade low. Here's that chart here for silver miners' capex cycle, and down 18% year on year since around 2013. As we talked about on Monday, we're seeing real signs of inflation take hold. Inflation continues to gain force. As we elaborated extensively in our prior letter, rising consumer prices are likely the end game for speculative asset bubbles in the financial markets. In the last several weeks, we've noticed an important move in that direction. Commodities just broke out from a 12-year resistance line. We've not seen this asset class sustainably appreciate in a long time. It is now occurring while the Fed seems forced to continue running the economy hot. Monetary policy has become a funding mechanism for government spending. Massive central bank purchases of treasuries also serve to suppress interest rates, while enabling the US government to run a large fiscal deficit. We believe the combination of unprecedented levels of government stimulus with investors beginning to flock to scarce commodities and driving these asset prices up, it will set an inflection point for inflationary forces. Here's the commodities chart here from Bloomberg Commodities Index. However, zooming out even more, you're reminded of what this index did in the epic gold and silver rally from the turn of the century, and also the big run of silver had up to 2011, again on the rising commodities index. So here's this chart zoomed out a little bit more, just for perspective. Last night, silver gained nearly 3% in the session, and gold up 0.6%. This is not an unusual trend as the GSR drops. Since March 2020, the outperformance of silver and the mining stocks relative to gold only adds to how early we believe we are in the cycle for precious metals. Looking back in history, gold tends to lead during the bottoming and an early bull market phase of the cycle. Gold outperformed silver and mining equities from its 2015 lows up until March 2020, at which time the other two groups completed a full retest of their 2015 lows. Since March, silver and stocks have led as gold has also moved higher. A look at the gold to silver ratio in the chart below shows that it has drastically moved lower since March and is ripe for an even more meaningful multi-year breakdown. This is an important piece of the macro puzzle. After the initial phase of gold's relative strength, silver and the mining stocks tend to outperform the duration of the precious metals bull market. Here's that GSR for you here in this chart. Something to ponder there. Well, that's news for today. I hope you enjoyed it. It's a bit long, but well worthwhile there from Chris Cat. Remember ainsleyBullion.com.au if you're interested in some silver. Some stuff you can hold in your hand. Gold as well, and platinum. ainsleywealth.com.au for all things cryptocurrency. If you're interested in Bitcoin, Ethereum or large cap crypto, that's the place to jump into. And if you're liking gold and silver but don't have a space to store it or not that keen to hold it, check out our own cryptocurrency product built by Ainsley. It's the Gold Silver Standard. You can check that out at goldsilverstandard.com. We'll catch you tomorrow for more news.